So there's some myths that we should clarify before going further. And one is that quantitative easing is the same as printing money. And politicians, journalists, market participants often refer to QE as printing money. This is because when the Fed buys bonds from banks, it does so by crediting those banks' accounts at the Fed with reserves that didn't exist before. But it's misleading to call this process money printing because it actually doesn't do anything to increase the amount of money in circulation. In fact, in our monetary system, most money is created by private banks, not the Fed. So when banks lend you money on your credit card, that's printing money. But when the government buys bonds from banks, it merely raises the price of that particular type of bond and lowers the interest rate. We know that when the price of bonds goes up, the yields go down. So lower interest rates, it hopes, encourages consumers to take out loans and spend. But it doesn't actually lead to more money in the system unless banks create money through making loans, and banks won't do that unless they identify profitable lending opportunities. The second myth is that quantitative easing will eventually lead to inflation. This is a big reason of fear, but if the government literally began printing money and started mailing out new $100 bills to citizens, this would lead to price inflation. But quantitative easing isn't the equivalent of mailing out $100 bills. It's merely managing long-term interest rates, much in the same way the Fed has always managed short-term interest rates. This is not to say that the Fed policy can't ever lead to inflation, and keeping interest rates low for too long can encourage the sort of spending that would cause prices to rise too quickly. But the backbone idea behind this is that interest rates are too low right now, and it doesn't make a lot of sense given the large amount of slack in the economy, as we're seeing with high unemployment and stagnant wage growth in U.S. economic indicators. Another myth is that quantitative easing is responsible for the recent stock market highs. This argument is of stock market highs because of the result of QEs is wrong. Federal bond buying will cause bond prices to be higher and interest rates to be lower, as I said before, and this will encourage investors to choose stocks over bonds at the margin. But no amount of federal bond buying is going to cause a particular stock to be a good buy if an investor doesn't think that the stock will provide a good return. So QE may boost profits by reducing the interest rates that firms have to pay on their debt, but it's not going to create profitable enterprises out of thin air. So a much more plausible reason for the record stock prices is that corporate profits and profit margins are at all-time highs because the cost of debt is at an all-time low. So what's the point of QE and what effect does it have? So buying long-term government debt and mortgage bonds, the Fed lowers the interest rates companies and consumers pay to borrow money. On the margin, this will lead to a bit more investment and slightly higher stock and home prices. But the theory that it's boosting wealth through these channels, consumers and businesses will be more confident and willing to spend. But the press often refers to QE using terms like massive and unprecedented. And it doesn't mean that it's a particularly risky policy or one that deviates much from what the Fed normally does. And that's why we shouldn't get too worked up about it's being phased out or wound down in the future.